Hey everyone, ready for another deep dive?
Always.
Okay, so today we're going to try to figure out what's going on with Warren Buffett, specifically his cash holdings.
Oh, yeah. That's been making
For
headlines.
sure. So we found this YouTube video that breaks down the situation, and they've got some pretty mind-blowing numbers. Like, get this, Buffett currently has $341 billion in cash.
Wow, that's billion with a B.
Billion with a B. That's like over half of Berkshire Hathaway's total portfolio. So the big question everyone's asking is he like predicting a market crash and getting ready to buy low, or is there something else going on? What do you think?
Well, I think the key here is context. Like, we can't just look at this giant pile of cash in isolation. We need to see it in light of Buffett's past behavior, especially what he's done during previous market downturns.
Okay, so like what happened during the dot-com bubble burst or the 2008 financial crisis? Did he like hoard cash then too?
Well, in 2008, he actually deployed about $20 billion into various businesses and securities. So he clearly saw opportunity amidst the chaos. But what's interesting is that his current cash position, even though it seems huge, isn't that much higher than his historical average.
Really? So this might not be as unusual as some people are making it out to be.
Exactly. Right now, his cash is about 56% of his portfolio.
Yeah.
His average over time is around 49%. So not a massive difference. But here's where things get a little more complicated. Buffett's investment strategy is not like, the average investor. He's not buying a few shares here and there.
He's buying entire companies, right?
Exactly. And not just any companies. We're talking massive acquisitions.
Yeah.
To make a dent in a company as large as Berkshire Hathaway, you need to be looking at companies worth billions, maybe even trillions of dollars.
Yeah, that makes sense. It's not like he could just buy a Fortune 500 company with like spare change.
Exactly. And this actually limits his options significantly. Plus, don't forget, he's been selling off stock lately, too.
Yeah. All right. Apple, Bank of America, Chevron, some pretty big names in there. It makes you wonder what he's thinking.
It definitely does. I think it would be helpful to take a closer look at what he did during the 2008 financial crisis. Maybe that'll give us some clues about his current mindset.
Okay, so back to 2008. What was Buffett doing then? What was he saying about the market?
Well, in his annual letter that year, he talked about how he'd never seen the stock market decline at such a rapid pace. He was also pretty concerned about the level of government intervention happening at the time. He actually thought it might lead to runaway inflation.
So even the Oracle of Omaha can get things wrong sometimes.
Oh, absolutely. His inflation prediction didn't exactly pan out the way he expected, at least not right away. But, it just goes to show that even the best investors make mistakes. It's all part of the process. The key is, how do they learn from those mistakes?
So what did he do right during that time? What were some of his good calls?
Well, one thing that stood out was his continued optimism about the U.S. economy over the long term. He famously said, if you're going to make a bet on the U.S. economy in the long run, you will do well. And he really put his money where his mouth was. He made several strategic acquisitions, particularly in the insurance sector, which he felt was undervalued at the time.
So classic Buffett, buying when everyone else is selling. But if he's such a believer in buying during downturns, why isn't he doing that now?
Right, that's the million-dollar question, isn't it? And it brings us to one of Buffett's key investment principles, his circle of competence.
Yeah, I've heard him talk about that. The idea that you should only invest in what you understand, right?
Exactly. He's known for saying he prefers to invest in things like financials, which he understands well, over, say, tech companies, which for a long time were outside his comfort zone.
Although he did invest heavily in Apple a few years back.
Right, that's true. But his rationale was that Apple was more of a consumer product company than a pure tech play. He saw the iPhone as more of a lifestyle product, something he felt he understood.
So even the Oracle of Omaha can change his mind. But let's go back to this huge cash pile for a second. Could it just be that he hasn't found anything that meets his criteria yet?
Oh, absolutely. And we need to remember the size factor we talked about. Even a successful investment in a company worth, say, $1 billion wouldn't really move the needle for Berkshire Hathaway. It's just not big enough to make a real impact.
So it's like trying to fill a swimming pool with a teaspoon.
Exactly. So the scale at which he operates really limits his options. And it makes you wonder, what kind of company could actually make a difference to Berkshire Hathaway at this point? It would have to be huge. Like back in 2002, he was already looking for acquisitions in the $5 to $20 billion range.
Wow.
And considering Berkshire's growth since then and the amount of cash he has now, it wouldn't be surprising if his target range today is more like $50 to $220 billion.
That's crazy. There can't be that many companies that fit that bill.
Right. So it does make you wonder if he's just biding his time, waiting for the right mega deal to come along.
Uh-huh.
But there's another piece of the puzzle that we need to consider. His recent sale of Apple stock.
Yeah, that was interesting.
Was that just a portfolio adjustment, or is it a sign of something bigger?
Good question.
We'll have to dig into that in the next part of our deep dive.
Yeah, the Apple sale is kind of strange when you think about what Buffett has said about them before.
Right.
He called them a different kind of tech company once, almost like a consumer staple, you
Yeah.
know? Because like everybody has an iPhone.
True. So why is he selling now? Do you think he's like turning against tech altogether? Maybe he's expecting a downturn.
It's possible. Remember, at his core, Buffett is a value investor.
Right.
He looks for companies that he thinks the market is undervaluing, companies with good fundamentals and a strong competitive edge.
So maybe he sees Apple's growth slowing down, or he thinks the stock is getting a little overpriced. Yeah, good point. Or maybe he still believes in Apple long term, but he just wants to cash in some of those gains after how well the stock has done over the past few years.
Makes sense. Okay, so this brings up another question. Could Buffett be using all this cash he has as a way to, like, protect himself from a potential market crash?
Oh, interesting.
Like, is he trying to time the market so he can buy low when everyone else is panicking?
I mean, it's easy to look at what he's doing and think that, right? Especially
Right.
with his track record of making some really good investments during past market crises.
Yeah,
But he said many times that he doesn't try to time the market.
that's true. But sometimes actions speak louder than words.
Right.
I mean, the fact that he has so much cash right now
Mm.
and that he's selling off some of his stocks definitely seems like he's at least being cautious, if not outright bearish on the market.
Yeah, I see what you mean. This is where I think it's important to differentiate between market timing and value investing. Market timing is all about trying to predict those short-term ups and downs in the market, which is really hard to do consistently, even for the pros.
For sure.
Value investing, though, is about finding those hidden gems, assets that the market is undervaluing that will go up in price over time, regardless of those short-term swings.
So are you saying that maybe instead of trying to time the market, Buffett's just being a disciplined value investor,
Yeah.
just patiently waiting for the right opportunity to come along?
Yeah, that's probably the most likely explanation. He's not trying to catch the bottom of the market perfectly. He's just looking for good, solid companies that are trading for less than they're actually worth. And when he finds them, boom, he's got the cash ready to go.
Okay, that makes sense. But it still leaves me wondering, is there something that he's seeing in the market right now that we're missing? Something that's making him hesitant to invest?
Well, there are a few things to consider. Like valuations are pretty high right now, especially in certain sectors like tech.
Yeah.
That makes it tougher to find bargains, even for someone with as much capital as Buffett.
Yeah. And we can't forget about all the macroeconomic uncertainty that's out there, rising interest rates, inflation, even those geopolitical tensions going on. It's definitely weighing on the market.
Absolutely. All those factors are probably contributing to Buffett's more cautious approach right now. He might be the Oracle of Omaha, but he's not immune to the broader forces shaping the market.
Yeah, that's easy to forget sometimes, especially when you're talking about someone like him.
For sure. I mean, at the end of the day, he's subject to the same realities as any other investor. But I think what sets him apart is his incredible discipline and his commitment to his investment philosophy. Remember, he's all about value investing. He looks for companies that have what he calls a wide moat.
A moat, like a castle.
Exactly, like a durable competitive advantage that protects them from competition. And he's also a long-term investor. He's not looking for quick flips.
Right.
He wants companies that he can hold on to for years, maybe even decades.
That long-term perspective is something I think a lot of investors could learn from. It's so easy to get caught up in all that day-to-day market noise. But, real wealth is built over time. You find good businesses, you invest in them, and let those earnings compound.
Totally agree. And, while it's great to learn from Buffett's moves and what he has to say, it's important to remember that we all have our own unique situations and our own levels of risk tolerance. What's a great investment for him might not be right for someone else, especially if they have a shorter time frame or if they're not as comfortable with risk.
Really good point. We shouldn't just blindly follow what he does.
Yeah.
We all need to figure out what works best for us based on our own goals and our own situation.
Exactly. It's all about finding the right investment strategy for you, something that helps you sleep well at night.
I like that. So maybe we can't replicate Buffett's success exactly, but we can try to learn from his discipline, his focus on value, and that long-term perspective.
Definitely. And maybe even more importantly, we can learn from his mistakes. Because even the Oracle of Omaha isn't perfect, you know? His missteps just remind us that investing isn't about being right all the time. It's about having a solid process and knowing how to manage risk effectively.
Well said. But before we wrap up this part of our deep dive, there's one more piece of Buffett's investment philosophy that I think we need to touch on.
Okay.
His focus on intrinsic value.
Ah, yes, the cornerstone of value investing. What's so fascinating about this concept is that it forces you to look beyond the current stock price and really try to assess the underlying worth of the business itself.
So it's like looking beneath the surface to understand what the company is truly worth,
Yeah.
right? Based on its assets, its earnings, and its future growth potential.
Exactly. And this is where things get really interesting, because figuring out that intrinsic value, it's not exactly a science. It involves making educated guesses about the future. And the future, as we all know, is inherently uncertain.
So it's more an art than a science.
I'd say so, yeah. And this is where Buffett's decades of experience and that sharp judgment of his really come into play. He's been analyzing businesses his whole life, and he's developed a pretty amazing intuition for what really makes a company valuable.
This kind of highlights another important lesson we can learn from Buffett, right?
Yeah.
We need to develop our own investment skills and our own judgment. We can't just rely on other people to tell us what to invest in. We need to learn how to assess value for ourselves.
Absolutely. And that means doing our own research, learning how to read financial statements, and building our own framework for how we evaluate businesses.
So it's about becoming informed investors, not just passive followers.
Exactly. And while that might sound a little intimidating at first, it can be really rewarding too. There's a real sense of satisfaction that comes from truly understanding the companies you're investing in and making those informed decisions on your own.
I totally agree. But, we also can't forget about the psychological side of investing.
Oh, right.
Buffett is famous for having amazing emotional discipline. He can stay calm and rational even when the market is going crazy.
That's such a crucial skill for any investor, especially in times of uncertainty. When fear and greed take over, it can lead to impulsive decisions that can really damage your portfolio.
So how do we learn to do that? How do we cultivate that kind of emotional discipline? Is it something you're just born with, or can you learn it?
That's a great question, and one that we'll explore in the next part of our deep dive.
Ooh, cliffhanger.
We're going to talk about some of the psychological traps that investors fall into and some strategies to stay calm and rational even when the market is throwing curveballs.
Okay, so we're back, and we're going to get into the psychology of investing.
Right, because it's not always about numbers and spreadsheets, right?
Definitely not. It's amazing how much our own minds can mess us up when it comes to making good investment decisions.
It really is. Like, so often our emotions just kind of take over, even when we know we should be thinking logically. Fear makes us sell at the worst possible moment. Greed makes us buy into all the hype, and then we end up paying way too much.
Yeah, it's like we hear those sirens going off, but we can't resist them. Like that old saying, be fearful when others are greedy and greedy when others are fearful.
Exactly.
But how do you actually do that?
Well, Buffett's a great example of someone who's really good at detaching himself emotionally from those market swings. He doesn't freak out when the market tanks, and he doesn't get carried away when everyone else is making a quick buck.
Yeah, but that level of calmness just seems impossible. Like, how can we, mere mortals, learn to keep our cool when the market feels like it's on a roller coaster?
Well, one of the best things you can do is to focus on the long game. Remember, investing is a marathon, not a sprint. Those short-term ups and downs, they're just part of the journey. The market usually rewards people who stay invested in good companies over the long haul.
So instead of checking our portfolios every day and freaking out over every little dip, we should be thinking about where these companies will be in like 5, 10, even 20 years.
Exactly. That kind of long-term vision helps us weather those inevitable storms, and it helps us avoid those knee-jerk reactions based on what's happening in the market that day or that week.
It makes sense, but honestly, it's hard to ignore those emotions sometimes,
Yeah.
especially when you see your own money going up and down. It's hard
Yeah.
not to take it personally.
Oh, I know. It's human nature. Another thing that can really help is diversification. When you spread your investments across different types of assets, sectors, and regions, you're basically reducing the impact that any one investment has on your overall portfolio.
Right. Don't put all your eggs in one basket, as they say.
Exactly. It helps smooth out the ride a little bit and lowers the risk if one of your investments goes south.
Okay, so we've got long-term thinking, diversification. Any other tips for keeping those emotions in check?
Yeah, this one's super important. Have a plan.
Okay.
and stick to it.
I like it.
Before you even start investing, you need to know what your goals are, how much risk you're comfortable with, and what your time horizon is.
Okay.
This basically becomes your roadmap. It guides you through all those market ups and downs.
So basically, we need to come up with a strategy that works for us, our
Yeah.
own goals, our own situation.
Mm.
That way we're not just reacting emotionally, no more fear-based decisions or chasing the next hot stock.
You got it. And remember, your plan should be flexible enough so you can adapt to changes in the market, but not so flexible that you're constantly jumping from one thing to the next, chasing every little trend.
It's like finding that balance between discipline and being able to adjust when you need to,
Yeah.
which is harder than it sounds.
It is, for sure. It's a balancing act. But if you're willing to put in the time and effort and you're committed to learning as you go, you can definitely get there. Because remember, investing, it's a journey, not a destination.
Hmm.
There's always something new to learn. The markets are always changing.
Well, this has been a fascinating deep dive, to say the least.
I agree.
We've talked about Warren Buffett's massive cash hoard. We broke down his investment philosophy. And we even got into the psychology of investing, which was really interesting.
Yeah, it's been fun exploring all this with you. So, what are some of the key things that stood out for you today? What are you going to take away from this conversation and apply to your own investing journey?
Those are great questions for all of us to think about. And listeners, we'd love to hear from you too. What were some of your biggest takeaways from our deep dive? And until next time, happy investing, everyone.